Hey guys, David and Mike, the Discount Property Investors. We're coming to you today with some knowledge about some of the real estate formulas that we use in our business.
What is the 2% rule, guys? The 2% rule is an easy way, kind of just off the top of your head, to analyze a rental property to find out what kind of cash flow it's making. So if you have a property that's worth, say, $100,000, to get 2% of that every month in rent would be $2,000 a month. So that's a little bit difficult to do. Dave, why is that difficult to do, and what does that mean for you when you're evaluating your properties?
Well, it's difficult to do because typically whenever you find a house, let's say for example that is $40,000 to be all in, right, to purchase it and be all in with your rehab and repairs or whatnot, and then it should rent for $800 a month. And there's lots of deals out there, right? But the downside to the 2% rule typically is they're in areas of town with lower income, higher crime, I guess less desirable areas. So in less desirable areas doesn't mean that's not a place that we won't invest. We invest a lot in those areas. However, you're going to have a higher turnover and typically a shorter term with those tenants. Not always, typically. Last but not least, the eviction rates are going to be higher in those vicinities as in the nicer neighborhoods. So with risk, Mike, comes reward. So whenever you go into these areas where you can get a higher ROI on your money, you're going to have higher risks of having to put more money into this particular investment to keep it rolling. So 2%, very similar to the 1% rule, guys, but you're going to be bringing in 2%. So a great example will be a $40,000 all-in house with rents at or above $800 in this scenario.
The 2% rule, guys.